Good afternoon, investors. Welcome. Thank you for joining us here on in what is, in at least in southeastern Michigan, a wonderful sunny day. Not too hot, but it's hot enough that a good air conditioner is good to find and have. My name is Mark Robertson, and I am joined by my dear colleague who is now air conditioned, Ken Kavula. Good afternoon, Ken.
Yep. Feeling good, Mark. Feeling real good again. So we had an absolutely gorgeous day, folks. I'll make you all jealous when I say it maybe reached 76 degrees with low humidity yesterday, and it was absolutely beautifully gorgeous yesterday. Nothing to complain about at all after that weekend of mid-90s. So
Yep. We'd venture out and played tennis last night until we could no longer see the ball. So that was time to quit. We're also joined here by Matt Spielman. Good afternoon, Matt. Thanks for coming and joining along on this wild bull ride.
Yep. Good afternoon, Mark. Good afternoon, everyone.
Kim is probably not going to be able to join us because she continues to work on, it seems like wherever she goes, she's working on a residential construction project management. So, all right. So, yeah. I guess this is where I say Toro Toro and wave my red cape, and we celebrate that it is the running of the bulls this week, by the way. The festival started, I believe, yesterday. And I don't know if they run the bulls every day of the week or if it's just one day. I don't know that. If anybody in the audience does know, I know that our daughter, while she was a student at Michigan State, actually attended the events in Pamplona. And yeah, it's I know that the weekend is the culmination of the Fiesta week. So that is coming up this weekend. But yeah, it is the running of the bulls, and we just kind of tip our hat in that direction. And as Ken said, those are definitely bulls. and he is definitely continuing on his fashion kick to be envied by all of us on the right. All right, so let's go into Matador mode and talk about our approach to investing. Anything else you'd like to add here, Ken?
nothing. Let's continue, Mark.
Okay, here is our truncated disclaimer. No investment recommendation is intended whatsoever. This is all about education and demonstration of a philosophy nearly 8 decades in the making, where we like to come together with friends, share ideas, discover opportunities, and exercise an analytical technique popularized by the modern investment club movement. And it's pretty cool. We are simply out there looking for excellent companies when they are selling at better prices, attractive prices, and elevated return forecasts. But please do your own homework before you make a decision about anything that we talk about here. We are not the boss of you. Make your own decision about things which help you be a better investor. And if you would like copies of the slides, have follow-up questions or suggestions for future topics, our 2 email addresses are on display right there. Anything else, sir?
Nothing. That one was longer than we needed it to be, so keep going.
Okay, we're gonna keep trying. All right. Well, some more time to waste. Portillos. Yeah, 4th of July, hot dog eating contest. I will never in my life understand a hot dog eating contest. I believe that Joey downed, was it 70? Somewhere in the 60s or 70s.
70 and a half.
70 and a half hot dogs. In how long, Matt? Do you know?
Oh, I don't know how long they got.
It's like a half hour or less, right?
Yeah.
Oh, that's just beyond me. And of course, our chart on the right displays that my deer holding in Portillos has once again gone into a trading range, hovering around $11 or $12. And someday, hopefully, that will end. Ken, I will make a mental note because you've admonished me in the past. If I am inclined to sell this company, I will be watching for an opportunity up here at 80, a relative strength index of 80. And as you pointed out, I had an opportunity a few months ago to sell this company after it had literally doubled in about a month and a half.
Asleep at the switch.
just, yeah, you got to pay attention in the realm of investing, apparently.
So I don't want to give you indigestion, Mark. They have 10 minutes.
Yes, John and Phil both have come up with 10 minutes, Mark. So
10 minutes. Oh,
10 minutes. I know.
that's even more gross. All
If
right.
you could eat hot dogs that fast, you'd never miss a trade.
Oh, touche. Ouch. All right. And thank you, Matt, for sharing that for this past weekend. Yes, indeed, Portillos was mentioned on CBS Sunday morning. It was actually a feature about no ketchup on hot dogs in Chicago, but they did spend 3 or 4 minutes actually showing Portillos and going inside and showing them making the hot dog, and he got the reporter was actually yelled at when he tried to put ketchup on the hot dog. This happened. So yes, I feel like this is a coming of age moment for Portillos, and hopefully that stock price will just shoot up like a rocket.
Mark, is the adjective tapped in front of onions a Chicagoism?
I don't know the answer to that.
Okay, I have no idea what a tapped onion is.
Well, they apparently are fresh and tapped about a bunch of stuff. It's more than just hot dogs. Anyhow, enough with that. All right. This week we are celebrating a number of things, including some really cool fireworks in our area. Love sandcastles this time of year, a good beverage. We will talk about the Buttonwood portfolio, and I did want to share an experience that we had with an investment club this past week, and I continue to love that quote. This is what the modern investment club movement is about. It is about being disciplined and patient and basically waiting for superior results after you stack the deck in your favor, knowing that it is all about probabilities and that there are no guarantees of success, but you certainly can stack the odds in your favor for sure. All right. Any comments, Ken?
No comments.
All right. Here's our weekly chart. Those are quarterly bars for the value line arithmetic average. That's an index of the companies in the value line investment survey. And every time that green bar takes a dive down below that red line, and all those people show up on CNBC to say it's never going to go back there, and then Ken comes on and says, "Well, yeah, it's going to go back there someday. Just wait for it." And sure enough, it's done it again, Ken.
Well, and it's just pointing out that somewhere between 9 and 11% average return over really long periods of time. That line is what, at 10.5 right now, that expected return line, Mark? Is that what we're setting it at?
Yeah, it's about the slope of that line would be around 10.5%. Yep.
Yep. So we have our
That's reasonable.
Our variable quarterly bar hitting the red line, and that just means we're in a very average kind of a market right now, even though it seems like we've come a long way in a very short time, which we did. We also went in the opposite direction a long way in a very short amount of time. So we're just kind of coming back to average right now, and nothing wrong with that. I like a boring market for a couple, 3 months.
Yeah, well, there are still opportunities to be found, and yeah, there is. It's an incredibly unsexy market at 9% for return forecast, but that's okay. And then, of course, I'm a Faith Hill fan for life, and a good cup of coffee is a good thing too.
Yeah, we're getting a little bit of spread between the value line number and the MyPar number, but not enough yet for me to be concerned. I got concerned the last time that it moved up to almost 2% spread, but at less than 1% spread, those are basically the same numbers as far as I'm concerned.
Yeah, when value line was getting whipsawed, back in that time frame, so it's actually a fairly normal thing to happen during periods of market disruption. All right, here's our Nick DiVirgilio index of semiconductor funds. And I just find it amazing that they all hold the same stuff, but in different quantities, but they're basically all baking pretty well. And should have held on to the fund that I bought the day after tariff day. But I didn't.
It begins to make me wonder why I don't have a large holding in one of these, Mark. I just, this is kind of short-term relative return performance. Notice, folks, that it's only from April 3rd. So we're not looking at long-term performance here, but it certainly is spectacular short-term performance for this group of stocks.
It certainly is.
When was Liberation Day, Mark?
I think it
Was
was
that
April 2nd.
Was it April 2nd? So this was right after Liberation Day. Okay.
Mm-hmm. So they've been cooking along. All right, Ken, well, you should like these a little bit better than these are 10-year returns with a few notable exceptions. And notice that over a 10-year time frame, and that's where it really starts getting interesting. I loved the comments made by uh, people in recent bull sessions where they said, you really should have a semiconductor or two in your portfolio. Find one you like, find one that has promise, and own it. And it's just kind of fascinating seeing these. So Van Eck takes over the lead in this chart. I have always kind of shied away from featuring too many industry funds. These aren't even sector funds. These are industry funds. But it's kind of hard to ignore that they're up there. And I kind of put semiconductors in the challenging class of residential construction in terms of the difficulty of understanding. And they're both obviously both very economically sensitive, so that makes it a little more challenging. But I mean, it's true for both of them. I mean, there have been times when we wouldn't touch a home builder. Next thing you know, 2 years later, all those home builders are doing extremely well. Same thing with the semiconductors. Your thoughts?
Well, I really like Stephanie Link, Mark. I think she's a down-to-earth investor, and since she sings the same song as I sing as far as investing is concerned most of the time, when she gives me a succinct quote, and I'm going to paraphrase that quote because I'm not sure that I have the exact words for it, but she basically told one of her colleagues on a panel that if they were going to badmouth technology and if they were going to badmouth especially growth, then they weren't going to do as well as she was going to do in the market. And I look down this list right here, and all I see is the words technology and growth. I don't see the word value attached to any of these funds. And a lot of these have become very specific in growth, and they use the word technology. So, boy, I think that since these are the 20 best performers out of a list, what did you say, of over 400 different
650.
funds? 650 now, my goodness.
Yep.
So, and only 19 of them actually beat the market by 5 points of relative return. And one of those, number 11 with the yellow highlighting, is a really short-term number. So we'll leave it in the top 19, but we'll just put an asterisk by it that it's a really short-term number. I don't feel real bad about the roundtable coming in at 3 or 4% anymore.
No.
I'd love for the roundtable to be up at 5+ as well, but if you can do 3 or 4% in a group and play ball with these kind of funds, then I think that your group, whatever it is, whether it's your club or your personal investments, I really think you're doing a fine job and should celebrate whatever's going on. Beating the market is difficult, and beating the market by 3 or 4 or 5 or 8 or 14 points is even more difficult. And here we are looking at funds that have been doing that for 10 years plus.
Well, we've got our usual suspects here joining us here this afternoon, and you guys all know the drill here. You don't get there without this column being right, and you want to have enough growth in your portfolio. You always want that to be the case. So find it kind of interesting. Look at the quality of these in general. Pretty good quality. And of course, as Ken has already mentioned, Tom Lee is the guy behind FundStrat Granny Shots, and we'll take a closer look at that now. I do believe that I like a lot of what Tom Lee has to say. Ken actually reveres him in his his appearances on CNBC. But I think Tom Lee is a pretty good source, although I can look back over history and find some people that I thought were pretty good sources of ideas. That when I started following them a little bit closer, I brought the curse along with me, and their performance suffered because I was watching them closely. So be forewarned about this one. But Tom, smart guy. I do think it's interesting that you can go to Morningstar and see, well, what's he been buying lately? I find Robinhood compelling, at least as a story. And I watch Interactive Brokers brought by Matt to the roundtable and a couple others that fit that category. They've done very well for the roundtable.
Well, I like it, Mark, when it shows that he's buying some of the very stuff we were talking about last week. We were talking about the attractiveness of GE Vernova and GE Aerospace,
Mm-hmm.
and here he is putting those into the portfolio as well. This meets my personal list. Okay, I guess is what I would call it, my stamp of approval, because I go down the list real quickly and I find that I own 5 or 6 of these, which means he's probably speaking the same investing language that I'm speaking. I know for a fact he does. He's very aware of fundamentals, and he's very aware of growth. And I own 5 or 6 on this list, and Mark's going to follow this by the next 20 holdings or so, and I own 5 or 6 on that list as well. So I'm very pleased that I see them there, and I'm looking now at the ones that I don't own and creating a list. There's not too many that I don't know about on these lists here, but when you find one you don't know much about, that's a wonderful idea for you to put on a let's examine that and see where it takes us kind of a list.
Yeah, there's
I'm kind of surprised to see Garmin on the list. How about you?
I was surprised. There's a wonderful investment club out there on the Kansas state line near Overland Park. But yeah, I agree with you, Ken. I see a lot of community favorites here. The thing that you can use out there if you're an investor, if you're working with people just getting started in investing, is you take a source like this and just simply look over their shoulders and watch for the ideas. I think any of those highlighted are decent studies right now. I'm a little bit surprised to see Abbott on the list as assertively as it is.
I've owned
Probably.
Abbott for over 30 years, Mark. I'm not surprised at all.
Oh, well, me too, but
Yeah.
one of the first stocks we ever bought. I don't know what strategy class A is. I need to look at that one. I don't.
We'd be remiss if we didn't mention Kim's S&P Global is on the list as well there. Down 2 beneath Abbott. There it is.
And even more remiss if we don't mention this one.
PayPal, you got it. Kim's mentioned it often enough. Our friend Len, I don't know if Len's in the audience, but it's interesting that with all the trouble Fair Isaac has gone in on the press, on May 14th, Mr. Lee decided to put it into his portfolio there. It's 2% of the portfolio, Fair Isaac is. So maybe he decided that low price was an opportunity. That's the kind of decision that we make a lot of times when a stock hits an all-time low or a 52-week low.
Yeah, I wouldn't be afraid to put this on a watch list. Maybe watch for low RSIs as a place to jump in on some of these.
Mark, I'm not sure this relates to Tom Lee's slide, but John, our audience would like to know, could you compare XLK to XLC and tell him what the difference is, if any?
I don't know exactly what the difference is. I'm more familiar with XLK as a Fidelity Select fund. We can do that at a future session. I can pull out and see what XLC is. I believe XLC is the communications sector fund. I'd have to look.
I asked the question just so we can take a note and maybe answer that question later on at a future bull session. Yeah.
Sure. And we are going to talk about XLK with respect to the investment club that we visited. But here's a look at kind of the way we look at a fund like this. Here's the top 25 fund positions in the fund. And so you can see some of the growth numbers, financial strength, earnings per share stability. He's obviously, for the most part, going for companies that have pretty well established and reliable earnings trends, decent quality. And again, from top to bottom, it's a source of ideas.
Mark, on average, when you look at these mutual funds, you said that Manifest is looking at over 600 of them. Is the percent of assets held in the top 25 holdings usually this high?
No. I mean, the average fund
That
out there
was
is probably closer to 20% for the average
that
fund. This is
that was my feeling as well. So this Mr. Lee's fund is a little bit more concentrated, at least at the moment, than the average ETF or mutual fund might be, because this
he
is close to 70% of the whole portfolio we're looking at right now. Yeah.
right. He has 38 stocks. He has said that he will not basically go much above 40, if ever 40. So yeah, it's always going to be fairly concentrated. And again, a quick list of ideas to watch for. And again, the thing we would be watching for is some of the higher pars, as maybe ones to scratch our heads over. Nvidia and Google, interestingly enough, Netflix
And Amazon, you know.
and Amazon. I mean, yeah, those guys all got it hammered pretty well, and chances are they're still going to be in business in the future. So there you go. All right, switching gears a little bit. This is again, we show this quarterly. It's just a reminder that what we do works. I mean, you can take any one company and use it as isolated criticism, but when you start looking at 1,700 companies where they basically do stock selection guides using cash flow, so it's the first cousin to the stock selection guide known by the modern investment club movement. But what you're looking at here in a nutshell, and Ken, you probably have to help me here, we're just making a simple comparison. We're asking the question, what did you predict was going to happen? That's the red dots and the red jumping around forecast thing versus the green shaded area, what actually happened. So, for example, in that last actual result on the right, between June 2021 and June 2025, again, this just closed out, this 4-year period just closed out. The actual return came in, this is actually price appreciation, came in at 4.6%. The prediction 4 years ago, back in June 2021, was for 7%. So again, a little bit of a difference, not too bad. And I think most people would look at this and say, with a couple of exceptions for some weird periods in history, the green shaded area pretty much conforms. So the forecasts actually are pretty reliable in general. So again, not necessarily true for a single company so much. You can find exceptions all over the place. But when you start talking about a stack of portfolios, which is the way we think about portfolio management, not such a bad thing to use the return forecast to think about it in this way. Your thoughts, sir?
Well, especially, Mark, since we can't say that Value Line is so omniscient that it predicts when a recession is going to happen. So when it's making a prediction for 2008, 2009, that's 4 years before the actual year that we're looking at. So when the economy tanks and we get a great recession like we did in those particular years, beginning of 2008, moving into 2009, we don't expect Value Line to predict that that is going to happen at that exact same time. Happens again in 2019, going into 2020, and there's COVID sitting in there sometime. And so when these huge divergences occur, I think that Value Line is doing a pretty decent job of trying to maintain what would have happened if there wouldn't been some kind of exigent circumstances that suddenly made something tank, made something happen. Certainly they didn't think about a housing crisis happening in 2008, and they didn't think about a virus attacking the world in 2020. So
Yeah, absolutely.
I'd say too,
I'm,
this reinforces the comments around gold that you know, once you've gone through those unpredictable dips, you sort of catch back up,
yeah,
get back on track.
Yeah,
yeah,
if you stick with the discipline, absolutely.
and for the most part, Value Line is tracking that green graph pretty nicely. I mean, it missed the recession that we've been predicting for the last 5 years here, but we're in, you know, for most of the time, I think it tracks and has been tracking fairly consistently. It's taking us back to that 10% average 4 years from now. And again, we shouldn't be worried about a nice, solid average market over long periods of time. And we should be looking to beat that 10 by 1 or 2 or 3 or more points if we possibly can. That's the goal of any stewardship of any kind of stock portfolio.
Yeah, because then take a look at the next 4 years, right? What is the shape of the next 4 years? A flat line to nothing, like people talk about, or is it pretty much a bumpy line, kind of around 10%, just like the whole rest of the graph?
Yeah.
Yeah, I think my vote is for the 8 to 10% bumpy long term. All right, pressing on. All right, let's talk about performance perspectives. I've gone back to the 10-year trailing for most of the positions in here. Again, the companies mentioned are the 10 most widely followed companies by Manifest Investing subscribers. And what I've done here is inserted a few interesting things. First of all, there's a club visit we want to share with you and talk about. That particular club is in the top 4 on this particular chart. And we'll spend a few moments with them. But look at the Tin Cup demonstration, is cooking along pretty well. That's a 401k demonstration going back to 1994, behaving admirably. Gotta love the QQQs. Notice that our investing roundtable has percolated back to 3%. We hope it continues heading north and doing pretty well. The next button, Groundhog Nation, that is our collective performance. We're talking about thousands of stock selections made over the last 10 years, actually 19 years, and taken all together, all added up together, beating the market by 2 to 3%, which is just amazing when you think about it. So, Index Central, right down that lower third of the chart, what you could expect from investing in a variety of different indices. And Buttonwood's been doing a little bit better. That is actually the performance of the current portfolio, because I'm just trying to sweep some of the losses, realized losses under the carpet, under the bed. We are positive, but not 7.6. But we'll talk about that in greater detail at future sessions. But pretty good stuff. So Ken, I'm really sorry that you weren't able to accompany to go visit the club, because I was advised that I am the only male person to penetrate their veil of secrecy, and I've done it a few times, and that was a mistake not having you along for the ride. It was a great
Well,
time.
I'll tell you that if they would have been meeting just a little bit later in the morning, and I didn't have to get up at 6:30 to make it to the meeting, I probably would have been there. But my wife and I enjoyed a very relaxing day that day by doing some things we haven't been able to do for a while, and I didn't have any better investing or manifest investing duties to take care of, and it kind of was a very relaxing kind of a day. I'm really pleased to see Buttonwood moving up at least into the realm of the indexes now, Mark. I was a little bit depressed about Buttonwood and how it was performing, and I still think that we need to tinker with that portfolio a little bit more, but I'm becoming much more enamored of the choices we've made, and and the decisions that we've kind of kept to, even though a couple of them I think are a little bit hard to swallow. So we'll get to Buttonwood in just a second. Let's talk about these wonderful investors from the Mid-Michigan chapter.
Well, yeah, I mean, I just continue to be, I shouldn't be surprised whenever I encounter this, but we were talking earlier today about a club that you're going to visit out in Kalamazoo, Michigan, out west, having a very strong long-term performance. Of course, all of your clubs have strong performance levels, but we run into these all the time. I think about the club in Detroit that we visited a few months ago, and just basically knocking it out of the park. And this is a pretty good representation of the group that I met with just a few days ago. So let's go ahead and talk about them a little bit. Here's their portfolio, and this is definitely kind of a wow thing. From top to bottom, positive results. You can see the purchases made, some of them going back as much as 10 or 11 years. I listened as they described at one point their portfolio got up to 25 to 30% in Apple. You'll see that it is not there now. They've actually shed quite a bit of the Apple at near all-time highs a couple different times, and done very well. Good decisions made by this group of ladies. And they have added a cadre of mutual funds, or I guess they're all exchange traded funds. And you can see that XLK that was mentioned a few minutes ago is right there. I think I said Fidelity. I should have said Vanguard. Vanguard Select Technology, one of their holdings. What are your impressions, Ken? And they were working fervently on this, so I'm going to head you off at the pass. Yeah, that's a lot of cash. They were paying off a member and reallocating assets, so they were fervently working on that. So go ahead.
Yeah, my only comment, my biggest, it's not a complaint, it's an observation. And of course, I looked at the cash and I figured there had to be a reason for a club holding this much cash. And Mark assured me there was after he visited the group. But I'm always a little bit concerned when high performing clubs resort to mutual funds or ETFs. And the reason is that I think that those kind of investments, unless they're being used just as a place to park funds, and that doesn't appear to be what's happening. They don't appear to be parking money here. My experience is that investing in those kind of things usually reduces the performance. Now, this is a fantastically good relative return at 12% there. I mean, they're beating the market by 12 points. Come on, that's a lot to be able to do and to do on a regular basis. But look at the returns from the Vanguard Select Technology, that's XLK, all the way down to the Vanguard Staples, that's XLP there. And you'll notice Mark didn't even make one of them red. The last one is really red 11.2, negative 11.2. And I just don't think that they're contributing what they should be contributing to a stellar performance from most of the rest of the portfolio. I mean, check out the relative return of a couple of these tech stocks that they've put money into. Most of us know the story of Microsoft, but do we really know the story of Fortinet? I mean, 65%. Come on, folks. That's relative return. It's not annualized return. It's relative return. So if I were to sit down and become a member of this club, I would try to find ways to capture some of these capital losses that are sitting right here, and at the same time move that money into some quality single named stocks. I think they might be able to add a few smaller names to this top list here and still stay in a nicely diversified portfolio. And that's where I would, if I were a member, that's the kind of input I would be giving to the club.
Yeah, my first reaction, and we didn't have time to delve into it too deeply. They're not exactly parking cash. They're trying to be opportunistic and and take this exactly how I intend it. They don't need to do that because they're good at picking companies. You,
Absolutely.
you know,
Absolutely.
and I
Yeah.
think, you're talking about large baskets of stocks. The numbers are obviously going to be more tamed down. These numbers down here, they're going to be more stable, more, less frisky, if you want to think of it that way. But they don't need to do this unless they have some other philosophical or driving motivation for doing it. But hey, who's to argue with a 12% relative return for the whole portfolio? You just can't.
Well,
I mean,
Mark, my eye goes to a company like Photonics, for example, which is a growth forecast of less than 5%. But then I look two columns over and I see a potential annualized return or average return of 27%. And I say to myself, something's going on in the company that I would need to study before I would ever suggest dropping this one from the portfolio. My eye goes immediately to Viva Systems, where I see a par number of 3.2%. But then I look at the sales number and it's 12%. And I'm saying to myself, well, if I'm going to drop this one, I better be really careful about dropping something that's growing faster than 10% a year.
yeah, we talked
all
about
the
that.
all the advice that has been given is to be very careful when that kind of thing happens. So I don't see any real candidates for elimination from the portfolio as far as single stocks are concerned. Maybe there's a couple that stand out for addition to the portfolio, although none of those pars are extremely compelling right now, except maybe Alphabet's and Nvidia's, and they are quite good sized portions of the portfolio already. So again, my suggestion would be let's move to a couple more single stocks and let's capture some capital gains from those ETFs that sit at the bottom of the
Yep.
portfolio. Capital, I'm sorry, I said capture capital gains. I meant capture capital losses.
Well, they don't have
Uh,
any losses here in this group. I mean, these are all positive returns.
Uh, well, let's capture some smaller returns then from this
Okay.
group. Then
All right.
I was reading the wrong column. I was reading the
Yeah,
relative
you were
return
looking at the
column.
relative return. Yeah,
Yeah,
and we talked about Photronics, and one of the things as you dig a little bit deeper, you find that they are having a decline in cash flow. And we talked about this last week here, that a decline in cash flow, especially if it dips negative, can be a real warning signal. And that is happening at that particular company. And they've got
well,
pretty good representation in semiconductors. So,
and and the other side of the coin also, Mark, is that maybe you're not spending your time as efficiently as you should when one of your single stocks only occupies 1.5% of the portfolio. It takes as much time to follow photonics as it does anything else, but photonics is not going to move the portfolio that much in one direction or the other, no matter what it does, until it reaches an average holding of maybe 4 or 5%, something like that. I don't know, this might be around 20 holdings, so 5% would be a good solid average for a
mhm.
holding.
Well, I do hope if we put together our monthly or quarterly sessions that these guys will come out and we get a chance to follow up because if nothing else, I am not worried about them at all. It's
No, no,
great
and
stuff.
neither am I. Not with the kind of return that they're showing. No.
Right. One of the moments that we shared went back to a previous visit 6 or 8 years ago, and they had a fairly high concentration in Apple and technology back in that time frame. We talked about this article, which you can still retrieve at the web address down below here, and it was just pointing out it's okay to sometimes do this as long as you know what you're doing and you're doing it carefully. In this case, David Gardner, decent returns over the years. You guys can see the references on the left, but one of the messages I shared with this club 6 or 8 years ago was that's not the end of the world. Work on it, continue to work on it, but having that much in technology, again, is not the end of the world. And lo and behold, many of the companies, like Amazon, for example, left technology, and the pie shifted with nothing else other than somebody deciding to classify it somewhere else. And so if you're
That was exactly the point that I was going to make, Mark, that a lot of the technology stocks during this period are no longer technology stocks. They're in completely new sectors. We've had the creation of some new sectors since this article came out, and then we had a lot of reclassification of stocks that originally we thought were tech stocks.
So David Gardner has basically, he likes powerful consumer brands. He likes technologies with high returns on capital, all that kind of stuff. Decent track record. We need to update this for the stock advisor performance. But again, think back to that number, 12% for 30 or 40 years. The investment club we're talking about is somewhere in here. And I just say, wow. But anyhow, I just thought I would share that they actually thanked me for reducing any mode of panic that they may have been in 8 years ago when we got together. So good stuff. All right, switching gears and moving to a wonderful subject. It's wonderful for the first time in many weeks or months. Our Groundhog Challenge and the standings. For those of you not familiar, this is a contest for individuals and groups known as investment clubs for the most part. On February 2nd, Groundhog Day, you get $1 million that you can invest in 5 to 20 stocks equally placed. And this is the current update. By the way, Ken, we have our third leader at the top of the leaderboard in 3 weeks. Richard Corkins takes over the lead, coming from third place to first. We'll take a look at his portfolio in a second, but the average groundhog continues to chug along. All those numbers are improving. About 2/3 of you are beating the market. Both the Wilshire and the Value Line Arithmetic Average have clicked up to green positive numbers since Groundhog Day. And all is right with the world, Ken, when the monkey's number is still red. And it's even more right with the world when I am no longer sub-monkey.
I do notice, Mark, that you've tied Golden West Club with the Four Corners Club. They, even though they are separated by about $400, you've tied them. So that allows our top 10 to be the top 11. And to be honest, folks, there's been very little movement at all in those top 10 or 11 or 12 positions for the last month or so. They've been trading places up on the top up there, but some of us have been making very quiet moves to the top. I will not mention to my grandson in 31st place that I'm now in 23rd place. So he's not with us today, so he'll have to listen to this on the YouTube channel. But some names have made some significant gains in the last month. If you look at that column, Alex Castor, for example, going from 57 up to 28. The Plungers in Michigan going from 64 up to 32nd. So we have some big moves going on, but they're not happening in the top 10 at the moment.
At least not for now.
Not for now.
I should mention that I have gone from 169th to 130th. That's a pretty good move, Ken.
I think that's an absolutely wonderful move. It portends good things for the roundtable portfolio, maybe, Mark.
That's putting a silver lining on it for sure. But you can cue up the music from Jaws. 50 years ago, it came out, and everybody knows the theme song. And I'm coming for all of you. There you go.
Well, Betsy wants to remind us that in the beginning of the contest, she went from 150 to 5th. So you can make huge moves, but the longer the contest goes on, the more difficult the moves are to make. Cheryl wants to know, why are ETF holdings listed as cash in these roundtable portfolios? And I think it's more a mechanical reason than anything else, isn't it, Mark?
Pretty much. It has to do with us retooling some of the fund features that we have. It merely reflects a lack of coverage on our part of not covering that particular exchange traded fund, and that will be changing. I've already caught up with a number of them, as you saw on the plungers portfolio. These are all ETFs, and those are all very current at manifest. So
We don't know whose portfolio this is, Mark.
Which one?
The one that you inadvertently mentioned a name for. We're not mentioning any names for that portfolio because we haven't gotten permission to talk about that portfolio.
Oh, okay.
Names
Well,
attached.
in that case, I didn't, or I'm mistakenly made that reference.
Yes.
The exchange traded fund, they'll be covered pretty much across the board. Some of them are very difficult to cover just by what they hold. Here is Richard Corkins, our the new sheriff in town, the #1 leader. And there's a couple here that are uncovered individual stocks, and they are doing very well for Richard. Richard is also from Michigan, from the Ann Arbor area, I believe. He's a member of the Classic Strategy Investment Club that checks in at 34th, I believe. And you can see he went with technology. He definitely would be good friends with Tom Lee if he ever spent some time with him. And you can see the two companies on the right, by the way, that they're split about equally. They're both worth about $300,000 to Richard. And you can see some brief descriptions. We will attempt to add them to coverage also. When they're added to coverage, that simply means that the database which fuels the dashboards can access them and fill in all of these blank spaces.
I guess we should also just make the point, Mark, that a lot of stocks aren't in the database. A lot of stocks that have very short trading periods or have zero profits, or that are trading at less than $1 in their stock price, they're not in the database because it's almost impossible to do projections for them. And most of the numbers that you're looking at on the right of the dashboard come from some kind of a projected value. You have to make some calls, and you can't ask Mark to make a call on something when there's no data to make a call on. So that's why they can't cover some of these very, very speculative kinds of companies.
All right, I do have INQ in my Groundhog portfolio, so hopefully I can latch on to Richard's coattails a little bit there also, and continue my momentum. I had never heard of Big Bear AI until this morning, so we'll be taking a closer look at that one. All right, switching gears to Buttonwood, Ken. We're about 50 minutes in. Let's go ahead and try to wrap up our discussions here. We continue to make progress. Go ahead, Ken.
Mark, Ann is reminding you that you promised to put, she's written value and benchmark on the Groundhog list, and she's hoping that you can do that going forward for the next bull session. You were going to put up some dashboards listing where the value line was and where the benchmark was, so that they had some reference points for the Groundhog contest.
I'm 90% sure, unless I made an operator error, that I added the Wilshire 5000 to the club dashboards, or to the Groundhog dashboards.
Okay, great.
And I don't know if I got the other one or not.
Okay.
A little bit more digging.
And we're on it. Okay.
I thought I had the Wilshire done, so scroll down the list. You got to go down 120 slots to get to it, so make sure you.
Yeah, Wilshire is there. I don't have a number on there, but it's 1,030,000 right now. If you want to, right behind David Einhorn, so he's positive.
Okay.
For the year, by, $140.
And I'm lurking somewhere on a very nearby dashboard to that Wilshire.
Yeah, you're only 10,000 behind that as of yesterday.
There you go.
And Anne is always the southern, the gracious southern lady that she is apologizing to you because she just missed the Wiltshire. It's there. Okay.
Yep. Yeah, it's an unusual year. You got to scroll down to find it. A lot. All right, so let's talk Buttonwood for a few minutes, Ken. Continue to make progress since the last meeting, and again, the goal here is to keep the regular investing going on while maintaining a suitable par or return forecast to keep that column on the right headed in the right direction also. And we'll probably put this in graphical form and track it over time. But I have a lot of I'm liking this chart more and more all the time as I talk.
Put the graph over the top of the spinning plates icon. You know, the whole thing. Put the graph over the top of that.
Well,
We'll be all set.
as you know, we have the spinning plates graphic. So
I know we already have the graphic ready to go. Okay.
we're ready to go. All right, here's a quick look at the Buttonwood Bulls portfolio. This is actually a type of portfolio which I am alpha testing, or whatever you want to call it, for the next generation of manifest, which we are working on now. And this one provides a little bit different information to what you're used to. Again, just tinkering, but it allows you to look back at basically basis or selection dates and that beloved relative return and return since inception type characteristics. And you can see that we have a little bit less growth than we would like. We would like to see a little bit more, and we always want to be pumping this par number up a little bit. Quality's fine. Quality might even be too fine for a portfolio like this, and we definitely have some room for some exciting small company speculation here, Ken. What are your thoughts on the overall portfolio?
Well, I'm disappointed in a couple of the ones that we hold. I know that we've talked about Gentex ad nauseum sometimes, but it still maintains a par value that is enticing. So Gentex stays in the portfolio. I know we've talked about United Health quite a bit, and we've had a ongoing debate with some of our friends about whether this is dead money or whether this is a true turnaround that is going to start to manifest itself in the next year or so. I also know that we've taken a lot of discussion and a lot of hits about including Schlumberger in the portfolio.
It's part of the curse.
Yeah, folks feel that Schlumberger is not the kind of company that we think it is, and I've had a lot of comment from a lot of folks that they don't believe the par that's being listed for Schlumberger going forward. But that's the data source we're using right now, and that's the thinking that we have at the moment. It certainly hasn't performed anywhere near that par, but that's what our data shows us at the particular moment. We've had some outstanding companies in here, but you know, just when Lulu starts to get back on track, we start talking about tariffs again. So there goes Lulu down the drain again. So I don't know how many times we can ride the Lulu roller coaster before we get tired of it. And just about when we get tired of it and bail out is probably when the whole issue will be settled. That's been our luck recently. And Novo has certainly been a disappointment to us. I'm not sure why Novo is disappointing in such a fashion at this particular time.
Yeah, I don't think anybody
there's
understands
that much
it.
difference between Novo and Lilly. I don't think there's that much
No.
difference. But it is, and we have to own that. And so there's our rule of 7 or 8 in this portfolio rather than our rule of 5. And
I'm in complete agreement. I mean, Schlumberger, when we put it in the portfolio, I threw salt over my shoulder and clicked my heels together 3 times. And Schlumberger has never been kind. And, you know, the company is holding itself out as being reinvented and not the traditional Schlumberger. And here we go again. I'm having a CVS moment. CVS still hasn't completely reinvented itself as it promised to do 3 or 4 years ago. Um, I don't know. It's a tough one, but the other ones, you know, United Health and Lulu, of course, and Novo. What's the other one? Well, United Therapeutics, although it has recovered a bit, Ken.
And
United,
Gentex as well, yeah.
yeah, United Therapeutics had a nasty announcement within days of us buying it that shaved a significant amount off. So again, you just try to take a deep breath and believe in the discipline and be patient to some extent. That's one of the things I think with Gentex. I think we should be patient enough to hold on to it unless we get a legitimate selling opportunity. Because I think they are a victim of their industrial exposure.
Well, I'm focusing on our newest holdings, Mark, and our newest holdings have been IES Holdings, IESC, and Texas Roadhouse we just added to. So they're actually performing relatively pretty well at the moment. I also think one of the other problems, Mark, is that some of these stocks, with some exceptions, are being compared to extremely robust Wilshire 5000 performances. So that really shades the relative return numbers when the Wilshire is moving up 26%.
Hard to keep
You
up.
know,
Yeah.
it's hard to keep up with some of those. So you'll
Mhm.
get red relative returns, and we just have to keep that in mind too. That it's been an extremely robust market since we began this particular portfolio, and keeping up with a market that has a benchmark of 14% is not the easiest task in the world.
No. As far as United Health, I agree with the thoughts about it being possibly stuck in the doldrums for an extended period. I kind of have a hard time, unless we were doing it for some tax related reason, selling at an RSI of 42. So maybe we set a mental stop at 50 or 60 and think about exiting that position. Same thing holds true for Gentex. I think we wait for that to be. We have it as a mental stop right now, but we do have 2.4% in cash. Here's where I think one of the places we could go looking to deploy that cash. Deckers. I looked around the tennis court last night to everybody having new shoes on. Most of them were on, or whatever the name of that company is.
You weren't
And
looking right down at your own feet, though, were you?
no, mine are very dated Skechers, I think.
Oh, they're classics. Okay.
I have classic footwear, but
Okay.
the Deckers is certainly knocking it out of the park in a number of categories. Yeah, they have tariff challenges and production facility challenges and all that kind of stuff, but they are trading near a multi-year high, Ken, and quality's out the roof. The sales trend is impressive. So are the earnings. Um, Returns, which would basically give us a little bit of a boost in growth, a little bit of a boost in returns. I'm liking the story. For those of you who want to go deeper on this company, you can go to the YouTube presentation from the most recent roundtable and listen to Ann Manning actually give you a more depth on the company. It's a cash flow aristocrat with one bad year out of the last 10 and improving profitability, nice PE ratios, no debt. That's why this one can't do the math, can't divide by zero, and they have no debt. So I think pretty good candidate for addition to the portfolio. What are your thoughts?
Yeah, Mark, Phyllis was thinking that you were saying that Deckers makes On, and Mark was saying that On is a competitor to
Yeah.
Deckers. We know that Deckers has different brand names, and Phyllis is telling us Hoka for some of their shoes and UGG for others. And if you go and reference that presentation from Ann Manning at the last Mid-Michigan Manifest Investing Roundtable, you'll see that Ann went into great detail on many of the brand names that Deckers deals with. Our audience certainly felt at the roundtable that Deckers was a great investment, and they gave Ann an absolute majority of the votes going forward to add another $1,000. So I'm going to agree with you that Deckers is a good holding. That'll probably be enough to give it the kiss of death.
Well, and the other bright side of this, Ken, is, we take the audience with us, and Manning and the audience, so we can blame them if we're looking at a chart like this several months from now and Deckers isn't working out.
Oh, I'm turning on my control panel here to see if Ann has words for you for blaming her. And yes, her hands. No, that's not her hand. She has a question, and right now that I'll take a gander at in just a moment here. Okay.
Right. One of the other places that I like to go looking is to pull up that cash flow aristocrats, and the C list is just companies that have a single. Go ahead, let me have it.
No, I'm reading from Phil, who wants to know: is there a brand name for a classic sneaker like yours?
Well, one of my favorite pair is New Balance, so there you go. Those are definitely dad shoes. All right, so here we have a list of companies that have basically very strong cash flow characteristics, only missing 1 year of improving cash flow in the last 10. You recognize all of those names, and lo and behold, Deckers is here. And so these are companies that have been, again, I just go to the dashboard, I sort it by projected annual return from highest to lowest, and then I am wondering about shopping amongst any of these, especially these that have the exceptional quality ratings. And Deckers basically jumps off this page a little bit for me.
Well, when you first started this discussion, Mark, and sent me some of this information to take a look at, I thought we were going to be looking at Pulte Homes, and I was trying to make a case why I wasn't ready to go into Pulte Homes quite yet. But I'm glad to see you went down to Deckers right here.
Because we already own Green Brick.
Because we already own Green Brick. I know. So I'm supporting the choice in Deckers. Let's give it a chance and see what happens.
Okay, there we go. So, okay, Ann and the audience are on the hook in the Buttonwood portfolio. There we go. All right, quick update on the electric utility auto pay, whatever, the bill, where we pay the bills. And at last week's session, we described this new unusual investment. It's an alternative investment called QDTE. They use 0 days till expiration options to boost their returns. So we added a small slice of it to the portfolio, hoping to get weekly dividends from this. We just want to see how this goes. And we had estimated that they would be 0.249 or 247. I just changed them all to 0.25. And the reason that this is here is this one has come in at 0.229. So we were paid this much. So again, the key numbers here are we still have way more money than we ever invested in the first place in the portfolio. We've paid every single utility bill over the last 4 years from this portfolio and its dividends. And you can see that we are projected at this point in time, end of this quarter, to still have nearly $2,000 in cash. So that's your
We've
update.
also paid all taxes from this portfolio too. Yep. That we generated.
So those are the transactions we made, and we will update, the actual amounts that come in with these QDTE dividends as they materialize. All right. Our other quick update, we are more than halfway through this contest, heading towards Halloween. And these are the 20 companies, including one ETF, that we chose for our best small companies. That's Ken knocking on wood.
Yes, it is.
And not a lot of information here other than to point out, and I'll whisper it, we are doing okay right now. And there's a bunch of community favorites in here too. Anything else, Ken, or you just want to ignore that this happened?
I'm going to ignore that this happened and just make one small comment, and the comments about you don't have to hit 15 home runs. You only have to hit 1 or 2 for the portfolio to do pretty well.
Yeah, Technoglass has led this group in the last couple of years, and it continues to do very well. And Ken is taking credit for Credo, and I'll allow it as long as it keeps our number high enough. All right, real quickly, what we do archive all of these presentations on YouTube. Just search for the Manifest Investing Bull Session or Roundtable. Enter it into the search box at YouTube, and you'll find it. Here is Ann's presentation on Deckers. So that's our incriminating evidence for the future. You can go in and actually look at her comments on that. Here's that artificial intelligence one that many people have liked and written to us about. You can see it's got a fairly robust number of views. And Ken, we're already up to over 100. I think we've got to bring Vera back and Michael J. Fox. People seem to like that one. That and the Blues Brothers. All right. Hope everybody had a great July 4th weekend. We were nestled in and had a very nice experience with some friends out on a lake just west of here. Did roll out the flag for the weekend. You can see that's a pretty good sized flag on the left there. And I just get a kick out of Barry Butler, and he does some wonderful photography out of Chicago. And apparently Chicago had a fireworks ban this year. Show me the fireworks ban. Look at that picture. I think that's just hilarious. No city fireworks, so I guess the natives took it upon themselves to figure that one out. That's just wild. And again, the Portillos commemorative hot dogs down at the bottom. Happy 4th of July. Hope everybody had a great one. All right. Anything in the hopper? Any questions? Anything else I
No,
can mess up?
we've kept ourselves up to date. Thank you all for coming. We had a nice audience today for a hot summer, and hope to see you next Tuesday. Good afternoon, everybody.
Thanks, everybody. Take care.